Well, welcome everyone to this portion of the Business and Finance Symposium. We appreciate the time that you're spending with us. We're going to talk about a very important topic, which is succession planning for family-owned businesses and how do we prepare for an exit plan now. The three presenters that are going to be speaking are myself. I'm a tax partner with the firm. We're going to have Kevin Lynn talk about tax aspects of the business succession, and then Monica Jalife, she is going to talk about, well, once you cash out, what are you going to do with your money? How are you going to invest it? So the first part is going to be talking in general terms. What are the options available if you are thinking of exiting a business? The second portion, Kevin is going to talk about what are the tax aspects and considerations. And again, Monica is going to talk about, well, once you cash out, how do you invest your money and make sure that that lasts not only for you, but for your family? I will say one thing when it comes to succession planning and exit strategies. I mean, we can talk hours and hours upon this, and there are very different options that are available to a family or to a closely held business which they can execute upon. The purpose today is just to give you some information to think about the different options and alternatives available. And obviously, you can go back and determine what makes more sense for you. I will tell you one thing it usually takes 6 months to 18 months to think of a plan, evaluate different opportunities, determine the best one, and then execute on it. So generally, this is not a quick decision that can be made. Think about it this way: from a family business or a closely held business, this is the biggest asset that someone has, and they've been working at it for many years. So it's something that really takes careful consideration. So let's talk about a couple of things that people consider when they are thinking about succession planning. In my mind, there are really five major categories to consider. One would be a company sale where you completely exit. The other one would be a family transition where you actually pass this down to your family members. We're going to talk briefly about an ESOP, which is an employee stock ownership program or plan, which basically allows the employees to be owners of the company. Think of a 401k that is funded by the company stock. We also have management buyout, where in a situation where none work or the family members are not involved, but you have a good management team that can take over the business and ensure a payout, that is one particular option. And the last one we're going to touch on briefly is going to be private equity, which has its upsides and also has its downside. So let's talk a little bit first about the transaction, which is a sale of the company. Kevin is going to talk about the tax implications of this. But generally, from a tax perspective, there's two things to consider. One, you can sell the stock, or two, you can sell the assets of the company. In general, a stock sale will be more simple, and all the gain will be capital gain, whether you're a C corporation or an S corporation. And we're talking about a corporate situation. An asset sale becomes a little bit more complicated, and depending on the assets of the company, the ultimate result from a company sale, if there's no other succession plan that works, may be a combination of ordinary income and capital gains. What are the benefits and what are the differences? Well, when you sell the stock, there are no tax benefits that accrue to the buyer. They cannot write up goodwill, they cannot write up the assets, and don't have additional depreciation deductions for amortization. The downside here also to the buyer is that all liabilities transfer. So there are some companies that cannot transfer certain contracts or certain agreements and have to do a stock sale. An asset sale is more complicated, but what leads is to the non-transfer liability to the buyer. The seller retains for liability, and again, offers more tax benefits to the buyer in that situation. The most important thing to understand in this particular transaction will be the after tax net cash flow. What are you really coming out of one sale versus another, and what benefits mostly the company and the family members or the owners of that particular company? So again, that's very, very simple in a sense to think about. In that particular situation, there really is a lack of transitioning to other family members. I want to talk about a family transition specifically because of the dynamics that are involved in this. And I like to talk about examples. So I will use one example with a client we had, a very successful company that the father put together and actually built and had four sons and daughters. It was interesting because two of them were extremely valuable to the business. They were running it and they did a great job. The other two, one was not really interested, and the last one, he should not have been managing anything. It took them over a year for them to determine how they're going to structure that transition over to the family members. And they decided that the two brothers that were really qualified and were really running the business and making it grow were going to own a majority. However, they still left something for the other two siblings for them to benefit from the growth of the business and also benefit not only themselves but their children. The point with a family transition is that it might be very difficult because there are so many dynamics. Potential structures you can have: sale to family members, gift to family members, or partial sale gift. And I will say that at the end of 2025, some estate benefits may be expiring depending on what happens in the election. Uh, it is important to really think about this now if you will be doing a family transition and using gift to family members, because the exemptions or the estate and gift tax exemptions uh, will be affected after 2025, starting in January 1st, 2026. I want to talk a little bit about ESOPs because I will tell you this is a really, really hot topic. It is not, it does have a level of complication and it tends to be more expensive. But I will tell you that the easiest way to think about an ESOP is it's a 401k that is funded by company stock. So all the employees become owners of the company through a what we would say qualified retirement plan. There are very different situations if you're an S corporation or a C corporation. If you're a partnership, an ESOP will not work. And the differences are as follows. Assume that you have 100% sale to an ESOP where the owners cash out and all the stock is now owned by an employee stock ownership plan. If it's an S corporation, that ESOP is a non-tax paying entity. Therefore, as the income is allocated from the main company to the employee stock ownership plan, which is now the shareholder, there are no tax distributions needed to pay you the tax. So that is the biggest and most significant tax savings. The other tax savings that really accrues to the owners, if they choose to, is they can make that S corporation a C corporation. And there is a tax deferral under Section 1042 that when the owners cash out and sell to the ESOP under an S corporation, there is tax that the owners will have to pay, generally capital gains tax. If it's a C corporation and they structure the transaction correctly, the sale is not taxable or the proceeds are not taxable to the owners, provided that they invest their proceeds in qualified securities. A little bit more complicated, but there are significant tax savings. So I think the takeaway from an ESOP, as we're talking about it, because I have 3 slides about it, is number one, it is a sale to a tax exempt entity. Number two, the owners now become cashed out, and the ownership goes to all of the company members because it's a retirement plan. And number three, you have to think about the tax situation if you're in C or an S corporation. The taxing of the sale to the ESOP are very different to the owners, and they are there's a lot of potential tax planning that you can do depending on how you structure yourself. I do want to mention one thing about an ESOP. Think of an ESOP as you sell your stock or your ownership to the employee stock ownership plan, someone has to pay for that. And generally, it's a combination of the owners cashing out via company loans that are paid over time, and also via some bank debt. What will happen to your balance sheet? Your balance sheet will be affected. And what you need to consider are all your loan covenants because you might be out of compliance with them. So when you do an employee stock ownership plan, it's really important to have your lenders and everybody involved so they clearly understand the transaction, which they generally do, and it doesn't affect your loan covenants or your lending or your borrowing ability currently and in the future. So again, takeaways, very simple in the sense that look at your tax play, look at who's going to be owning it. And the last thing also I want to talk about in ESOP is that not only is it a tax play or a tax benefit, you also have to make sure you have a good management team that will take over and help continue the company grow in value. It only works if the company grows over a certain amount of time and continues to grow and make it more valuable for the ownership. Transition plan, which is a management buyout. This is an option that sometimes is chosen when there are no family members or any immediate individuals that really want to look at buying the company. But you have a fairly strong management team and an ESOP might not work for you. A couple of clients that I have worked with on this have been pretty successful at identifying 3 to 4, 5 or 6 key management and individuals that will continue with the company and continue the legacy. And if you structure this correctly, you're able to get sufficient cash to them to buy out the current owners. I think the key in this one, like anything else, is just proper communication and proper planning and understanding that company funds will be used to fund this buyout. And again, the really important item here is that you have a strong enough management team that will continue with the company legacy and will allow for your payout as an owner and also for them to get some additional payouts and also some growth opportunities for them. I think the last one that I want to talk to about briefly is private equity. And I want to kind of think about, uh, I want you to think about what this might mean for you. Generally, when you have a family owned business or you have a closely managed business, the owners are very entrepreneurial. They have the ability to make decisions on the fly and they are their own bosses. Private equity is a little different because private equity will allow you to take some chips off the table and will allow you to continue to be part owner as a rollover owner with some of the equity being held within the company. However, there's a couple of things I think that people need to understand when private equity comes in. Think of it this way. When you transition to your family, you know who your partners are if you still retain some ownership or who is going to be buying the company from you. If you have a management buyout, you also know who your partners are going to be if you retain some ownership or you know who the people who are going to be buying out from you. And if you have an ESOP, you also know your employees. You know your current partners, your future partners, and the legacy that's going to continue. I don't care what anybody says. When you have private equity come in, you don't know who that partner is going to be, really. You have to make sure that you choose someone who is going to provide value and growth to you, particularly if you're going to remain as part of the management team on an ongoing basis. Generally, that occurs because a private equity is a financial play. They're going to buy part of your ownership, they're going to let you cash out, and then they're going to hold that for 5 to 7 years, hopefully for another flip where they can increase their investment. A lot of times that I've seen in private equity is that the people who are buying, being financial buyers, might not be as akin or understand the business that they're getting into. So it's really important that if you choose a private equity partner or you go through the private equity route, you clearly vet and select carefully who that private equity group is. A lot of times they can add value. They can add value by having other consultants, bringing in some efficiencies, or access to additional capital if you need it for the company to continue to grow. But private equity is something that really needs to be looked at and really needs to be considered if it's going to go or you're going to go through this route. So again, that is a 15-minute primer on really uh, alternatives to transition your business going forward. Again, all our work, all are really good, but it depends on your needs and what you need to do with your company. Do you want to be completely out? Do you want to leave some legacy? Or do you want to leave something for the employees to actually cash out and continue to work in the business and be successful in the future? I think the most important thing to do when you're going through this process is to really sit down and determine what your legacy is and what you want to do with your company. And who do you want to have continue that company and the name going forward? And really be unemotional and make a decision as a business person. And I say that because oftentimes business owners make a lot of very good decisions when it comes to how to run their business and how to make investments. But a business that you have taken from nothing to a significant company or investment, it becomes a little bit emotional. And you got to take that emotion out and figure out what the best solution is, not only for yourself, for your family, or for your employees. So, with those things in mind, I think it's good to consider and look at all of them. And again, remember, this is not a very fast process and don't make it quick. 6 months to 18 months is probably the lead time to think about what you would like to do, how you would like to structure it, what are the tax implications, how it's going to be transitioned, and what is best for all the parties involved. So I think with that, we kind of did that summary as I talked about, talked a little bit about what you have to consider and the things you have to think about, a 15, 16-minute primer to think about it, but certainly there is a lot of information to unpack and it does take a while to make the right decision for you. I think now we want to hear Kevin talk a little about the tax implications, which I touched on a little bit, but I think he's going to get into more of the details of what it means to you on some of these different options as you transition your business. Kevin?
Thank you, Peter. That was great insight in noticing the various components that go into the succession planning and exit strategies. And thank you all for joining us today. So my name is Kevin Lin, tax partner in the New York office, and I am delighted to speak with you further on the tax implications associated with succession planning, either from family transitions or from sale to third parties. Let's go to the next slide. So, understanding the tax consequences or benefits can help you make informed decisions and minimize the financial burdens. Next slide. I want to go over a little of the different types of taxes involved that we'll be covering in this session. These include capital gains tax, gift and estate taxes, ordinary income tax, and other considerations. Each of these taxes can significantly impact the financial outcome of your succession plan. Next slide. So we heard earlier from Peter that typically a stock sale generally leads to one simple calculation, and all the gain is capital gain, such as the example calculation you see on the right side of the slide. So an example would be you made an investment of $500,000, ultimately sold it for $2 million. You now have $1.5 million capital gain. There could be short-term or long-term depending on how long you've held the asset. If you held it for over a year, typically it's long-term, where you do have a more favorable tax rate. So there are also additional nuances when there is an asset sale, since there's a combination of ordinary and capital gains. For sellers, it's typically more tax advantageous to sell stock that was held for more than a year to receive a more favorable long-term capital gain treatment. However, buyers typically want to buy assets in order to have the capability to potentially depreciate the assets while it's in service to reduce their current tax obligations. Next slide. There are several strategies to consider that may be applicable to minimize or defer capital gains tax. One option to defer capital gains is an installment sale. This is where we structure the deal to receive proceeds over multiple years, therefore spreading the taxable income over multiple years. It can be risky because there's always a possibility that the buyer can no longer continue payment for whatever reason, or factoring present value of money. But it's a good tool to spread out the income to defer and potentially keeping you in a lower tax bracket. Another strategy to defer is a like-kind exchange, or Section 1031 exchange, which allows you to defer capital gains tax by reinvesting the proceeds from sale of real property into another replacement real property, typically equal or higher cost. If you ultimately receive any cash or an installment note, typically referenced as a boot, you will be picking up capital gain. The third option, which allows you to minimize tax, is the Qualified Small Business Stock, QSBS, where it can provide significant tax benefits if your business qualifies, where you can exclude up to $10 million or 10 times the original cost basis, whichever is higher. To have a qualified small business stock, it needs to be a C corporation entity in a qualified industry with gross assets not exceeding $50 million immediately after the stock issuance. And finally, we have the capability to take any form of capital gains, either from sale of property, stocks, or other types of investments, and invest into a qualified opportunity zone, which are typically areas that are economically distressed. This program was created in the 2017 Tax Cuts and Jobs Act, and it is nearing the end of the program. But we still have time to defer our capital gains until the earlier of selling their stake in the opportunity zone or until the end of 2026. So whichever comes first. This is a great program because with 1031 exchange, you are only limited to real property capital assets, where you have to use the entire proceeds. But with the investments into the opportunity zone, you only need to invest the capital gains amount, so proceeds less the cost basis, from any capital asset. So you weren't limited of what type of capital asset, and you didn't have to invest the original cost basis, which allows some cash to come back to you. Next slide, please. So gift and estate taxes come into play when transferring ownership of the business to family members. You'll see that the lifetime gift tax exemption allows you to transfer a substantial amount without incurring gift tax. It's currently $13.61 million in 2024 and $13.99 million in 2025. Exemption is scheduled to sunset end of 2025, back to the original amount of $5 million, indexed to inflation, so I would say approximately $7 million. However, if the business is transferred upon your death, estate taxes may apply based on the value of the business. One significant benefit to consider is the step up in basis, which can reduce capital gains for your heirs by adjusting the cost basis to the market value at the time of your death. So if you have a business that has appreciated, those that inherit the business will have a higher cost basis and in theory can sell the business right away without any capital gains. Next slide, please. Certain types of income from the sale of your business, such as payments for consulting services, non-compete agreements, sale of an inventory, and so forth, may be taxed as ordinary income. And with the using of installment sale, which is spreading out receipt of payments, it could help manage these tax liabilities by spreading the proceeds over time and lowering your overall tax burden. The corporate structure of your business, whether it is an S corporation or a C corporation, can significantly affect the tax implication of a sale. So on a high level, S corps are pass-through entities, meaning income is reported on stakeholders' personal tax returns, avoiding any double taxation. In contrast, C corporations faces double taxation. So if you have a sale of assets, the corporation will pay taxes on any gain from the sale of the assets. And then again, the net proceeds after taxes, it will be distributed to the shareholders in a form of dividends. And the personal owners will then pick up income as dividend income. However, if it was a stock sale of a C corporation, you would avoid that double taxation. Next slide, please. So, given the complexity of tax laws, it is essential to engage with tax advisors, accountants, and attorneys who specialize in family-owned businesses. They can provide tailored advice and help you navigate the intricacies of tax planning. Regularly reviewing and updating your succession plan is also vital to ensure it reflects current tax laws and family dynamics. As the Tax Cuts and Jobs Act sunsets, and with the new upcoming president to be sworn into office, we will most likely see changes to tax policies. Next slide. In conclusion, understanding the tax implications of succession planning for family owned businesses is crucial for ensuring a smooth transition and preserving your family's legacy. By being proactive and seeking professional advice, you can minimize tax liabilities and secure the financial future of your business and family. So, thank you for your attention, and I am happy to answer any questions you may have. Now, let me pass it to Monica, who will go over the items to consider post succession planning.
Thank you, Kevin. Thank you, Peter. That was great. I'm Monica Jalife. I'm with Withum Wealth Management. And I'll talk a little bit about what you do. You've sold your business or you're preparing to sell your business. From a planning perspective, what are the things you need to look at? What can we help with? And considerations you want to take. Can you please go to the next slide? Just briefly, just to talk about what financial planning is. Financial planning can take many, many different forms. It can answer many, many different questions. I just wanted to put some here. Those not all might apply to you or as you sell your business, but just wanted to give a sense of what financial planning can address. And this is by no means a comprehensive list. It's just some of the things that we can help address as we work through financial planning. Financial planning is really understanding what your goals are, what's your time horizon, risk tolerance, what you want to accomplish, considering different different portfolio allocations, different market environments, and your different goals, right? Different timing scenarios. But what is the best way that I can leave assets to my children? Am I going to leave them with a big tax bill? Well, how can I avoid that? How can I reduce that? As Kevin mentioned, the estate tax exemption is potentially, we don't know yet, but potentially, if nothing is done, going to be cut in roughly half. So do you have an estate tax plan? I mean, do you have an estate tax problem? How can you address it? How can you reduce the taxes that you would be liable for? How can I save for my child's college, or do I want to pay for my daughter's wedding? I want to, save or want to buy them a house. What else can I do to manage my taxes? Can I make another investment? How do I fund my lifestyle and retirement in a very tax efficient way? And what could go wrong, right? What if I need care in the future? Can I self-insure? Do I need to consider other alternatives? And what happens if if the returns that I'm anticipating are not going to pan out? And how do we stress test for that? So generally, that is. And there's so many other ways in which we can address planning, but just wanted to give a sense for that. If you can go to the next slide, please. So as it pertains to selling your business, we need to identify the different areas in which you're going to categorize your capital, right? We'll start with what we call your core capital. And your core capital is just the amount that you need in terms of dollars to maintain or to have the lifestyle that you are looking for and to have a comfortable level of liquidity. Now, what is it important to consider is that as business owners, you probably have a lot of expenses that are run through the business. And you need to identify them, number one, because those need to be, quote unquote, added back to your core capital needs, right? Because the company might have been paying for your car or a country club membership or whatever it is, but you need to identify those to make sure that you are properly and accurately reflecting what are your core capital needs, right? And if you don't know what those expenses look like or what they are, with their Oasis team can also help identify. We've done that for other for other clients, but they can help with that. We can help with that as we go through the planning exercise. We will have more, a lot of questions, but these are the types of things that we will evaluate. Now, with the core capital, we will evaluate different scenarios. We will impact, or we will account for taxes, market volatility, time horizon, risk tolerance, different investments, and so on. Now, the other two categories, legacy capital and excess capital, those are more long term in nature. And I'll start with the legacy capital, right? The legacy capital is how much can I dedicate out of, what I netted out of my business sale to create a legacy for my family. What do I want that legacy to be, right? And how am I going to fund that? And here we can talk about different things. Funding your legacy capital with vehicles that will help with asset protection, like trust, that also will help with estate planning, especially if you do have an estate plan, if the amount gets cut in half. So how can we fund that? Also, if you are charitably inclined, what can you do to not only save on taxes, right, from the sale of your business, but also accomplish what your goals are in terms of donating to the causes that matter to you? Do you do a donor advised fund? Do you do a foundation with pros and cons? But this is the type of things where you would be considering as you define your legacy capital. And then finally, excess capital. Excess capital is basically any amount that's reserved for other opportunities. Perhaps you still want to be entrepreneurial. You still want to go and do another business. So there might be funds that you want to allocate to starting another business or not. But, this could be also capital that has different return patterns, that perhaps it's a little bit different on the risk scale, where you want to take a little bit more risk. You can do other things like real estate, opportunity zones, like Kevin mentioned, or you want to do hedge funds and so on. But those come after you have fully funded your core capital and your legacy capital. That's the excess capital. And we'll what's more important about this is that this will help you stress test for different scenarios, but it will also create a framework as what you need to do to grow your wealth, to maintain your wealth. If you can please go to the next slide. So I'm here, it's also important to know as you're preparing to sell your business, there's going to be taxes, of course. There's going to be, paying some liabilities that you might still have. You're still going to have a number that is what you are getting, and then you're going to get a number is what you're netting after it's all said and done and you're paying for everything. But do you know how much do you need to net from that sale of the business after taxes, like in your pocket, to maintain your lifestyle and to address all the different categories that we have mentioned in the previous slide? Do you know what that number is? And it's not that you need to start planning when you do the sale. Like if you're still planning a couple of years out, the time is now. You can still do, okay, what am I doing now? Am I saving already? Do I have a retirement vehicle? What am I doing now? Because by doing, say, if I have a couple of years, I could still reduce that reliance of what I need to net of the sale of my business to make sure that overall my financial plan looks strong and healthy. That is also very, very important, because you might not be doing as much as you can. If perhaps also you have excess liquidity from the business, you can be funding, and we can look at different scenarios and see what the impact. I'll have a slide on that shortly. But on this, just one last thing to mention on this slide is we do a Monte Carlo summary, a Monte Carlo analysis, which is just a statistical tool that will help us evaluate many, many different market scenarios, introducing the element of uncertainty that comes perhaps with being in markets, but seeing out of all those times that I was, looking to accomplish all my goals with my portfolio and with different market environments and different scenarios, how did I do? And that number that you see there, that 91%, just is a probability of success that is just giving you the aggregate result of all the different iterations. So it's just a way to really stress test that we don't know what's going to happen in 2 years, 5 years, 10 years. So it's a very helpful tool to just make sure you have a framework. If you can go to the next slide, please. And one, yes. Another very, very helpful and extremely visual tool that we will approach as we do planning is you're going to evaluate different scenarios. The blue, as you can see, the blue, dark blue charts, the assets are, that's your portfolio value over time till the end of your plan. Your assets are going down. But now I want to evaluate, what if I did a Roth conversion with all of my traditional IRA assets? What if I bought a rental property? What if I did another business? What if I get a part-time job? Different scenarios that you are evaluating, you can see it, and really on the fly, as you change the different levers, what is the impact to you and your plan? Not only, as you can see here, the second option, scenario B, increase the value gained in the life of the plan by $3 million. So how is the impact not only on assets left to my family, but also what are my impact on taxes? Was I able to reduce the cumulative taxes that I was able to pay? Or what is the impact in many other different views? My cash flow, and I'll show you a slide on the cash flow. You can go to the next one, please. This is the cash flow, right? And as business owners, you're probably running cash flow reports. You're paying attention to your cash flow. You have this, but what is fantastic is now you've sold your business, you still can have the same cash flow. You can look at your cash flow, this 5-year cash flow. And I think it's fantastic. It's going to show you the growth of your assets. It's going to break down the assets by different categories, right? Retirement accounts, taxable assets, insurance, and so on. And then it's going to also show in a very detailed way what's coming in, what's going out, my inflows, my social security, what are my outflows, right? It will separate your living expenses from your liabilities, insurance payments, and taxes. It does have a calculation for taxes. And we also can look at different scenarios and see what the real impact, real time on that is too. Just in this example, you can see in 2025 is the year in where they sold the business, and that's why the taxes jumped meaningfully. But we can also, to mention what Peter and Kevin were talking about, if you're evaluating different funding scenarios or different scenarios to sell the business, we can also do this analysis and see, along with their, Peter and Kevin and their teams, what is the impact to you from option A versus option B. If you can go to the next one, please. So estate planning, this is just a visual chart to show you. I mean, estate planning can be very complex. Right now, there's a lot of things up in the air, right? We don't know what the amount will be if the estate tax exemption does sunset. We don't know that. But it doesn't matter. We can help evaluate different scenarios. Do you want to gift, you want to gift just annually to your children because you want to make sure, you just still have enough for whatever could go wrong? Do you want to fund trusts irrevocable? Do you want to trust now? Do you want to fund a trust now or later? And we can show you, again, side by side, different scenarios and what that does, to your year life end taxes. What does that do to your heirs? How much are they keeping with one versus the other? And you can even get more nitty gritty. This is just a kind of overall view, but you can get extremely nitty gritty on the estate planning analysis that you can do. And that is just, again, information. And it's a tool that can help you evaluate different options. If you can go to the next one. So just to tie it all together, a financial plan is going to be an extremely helpful analysis and an extremely helpful tool that will give you a lot of information. And it will give you information to help you decide what is next, what are my goals, how do I accomplish them, what else can I do, what could go wrong. I will always want to see that, and what am I going to be leaving to my loved ones in the future or now, or what else. It's just really tying everything together: my goals, my expenses, my risk tolerance, my time horizon. How am I going to invest my assets? And if I want to be more conservative, what does that do to my plan? And you can see all these different life changes. And then, it is just something that it's not, okay, I did it. It is something that is like a living, breathing, exercise that you do. It's a plan that you do. And then your life situation might change post sale. And maybe you just don't want to start another business and you just want to travel the world. Whatever it is, this is just a tool that grows with you as you evolve in your life situation, as your life situation changes. And finally, I just wanted to show how we approach management, how we approach managing your portfolios and the different types of assets that we will use. We look at the world of the investing world in two different ways. We're going to have investments that are going to be a return generating investment, and then there's going to be other assets that we're going to put into the portfolio that are going to be to mitigate the risk within a portfolio. When we do the planning, that is one of the most important things we will do, which is to understand your goals, but to also understand your risk tolerance. Because I can come and say, well, you need a 100% equity portfolio, but you don't want to take on equity risk. So it is very important to understand what are the attitudes towards risk, what is the ability to take on risk, and make sure those match as to how we are doing and how we're investing the portfolio. So just to go, and I'm not going to go over all of them here, but some of the investments that you would see is the traditional investment stocks, bonds. Those are going to have um, are going to be your building blocks within the portfolio. But there's also going to be other investments which we might be more tactical, and it's not timing the market. It's just being more tactical as to when we can go in or out, or what is the environment more conducive to one investment versus the other. And then we'll also have alternatives to the degree that it makes sense in terms of, do you even need that? So it is all, again, tied all together in what you're looking to accomplish, right? And we will have fixed income in there, which is when things are not looking so good, fixed income is going to be kind of like that little shock absorbing section of your portfolio, but it's not going to give you growth, right? So again, it all kind of ties together with what you want to accomplish. And when you look below, and there is the types of, and it's just a sampling, but you're looking at municipal bonds, which would be tax free. You have government bonds. You have, just a regular, large cap, small cap, mid cap. You have international assets. You might want to have some hedge funds, some more liquid alternatives or illiquid alternatives. But all of that is going to kind of close the loop in terms of what we looked at and how we created the plan, and then how we're going to execute your plan over time. And with that, we'll take any questions. Thank you very much for your time.
So I just want to stress the importance of seeking out your advisors as early as possible. Because a lot of times we receive information after the fact. And by that time, it's too late. So the earlier the better. It could be even a few years before trying to make a move, because you want to make sure that you have the right structure in place. You want to make sure you understand all the tax implications that may be associated with it. And as Monica mentioned, what do you do with the net proceeds after taxes and other expenses associated with it? Can you maintain the lifestyle after the sale, or transferring the business to your family members? But going into those negotiations, you want to have all this information in mind. You want to be able to see the various analysis, and that way you could all make the right informed decisions.
Correct. And it's funny, Kevin, you say that because I learn mostly through examples. And I got, three quick examples that I can give of transactions. I think in the last 3 years, I've been involved with 10 different sales. So I have the good, the not the bad and the ugly, but the good, the not so good, and the ugly. The good one was a family-owned business where the mother and father owned it, and then both kids were involved. They're older. Uh, there's a couple of things I did really well. They wanted to cash out, but also leave something for the children, right? So obviously, both of them still work in the business, but they got a pretty nice payout. They were able to negotiate uh, uh, service contracts or management contracts for both of them, which they're still employed and doing really well. But two things to always think about when you do these transactions: get as much cash if you're going to sell as upfront as you can. And the reason for that is because of every transaction I've been involved with, that they have these earnouts. You know how many have received earnouts? None, none. So as a tax professional, I certainly focus a lot on the tax results, just like Kevin mentioned, but also from a negotiating perspective, there's a couple of things this company did right. One, they were ready. Their financials were ready. They understood the transaction and they were not emotional about it. And the last thing they did is they were hard negotiators and they negotiated up front for the biggest amount that they could get and really left very little for the earnout. Think of it this way: you run your business efficiently because you know it. What makes you think that someone else is going to come by and run it as efficient as you? Number one. And number two, they have no incentive to pay you an earnout because it's additional consideration. I think that was a good in the transaction. The not so good, I would say, was one particular taxpayer who uh, built a business very successful, but I think got to the point where this person was kind of done and went through two different rounds. And the second round didn't get as much as this person or this owner wanted because they were a little bit emotional about it, right? They thought their business was worth X and it was really worth Y. And it really was not worth as much because the cash flow and the EBITDA wasn't there. And I think it got to the point where the primary owner was, kind of done, said, "Look, I want to kind of move on." Uh, was able to negotiate a very successful exit, but I think that it would have been wiser to think ahead of time what the options were and think about it carefully, not to get to a point where I've built this up, I really had enough. I don't mind doing what I do from a technical perspective, but I want someone else to kind of carry it along. Uh, Again, it was successful, but I think in my mind it could have been a little bit well thought out, better thought out. The thing I would say about both situations is when you are going to sell a business, whichever transaction you choose, the family transition is not as intrusive from a financial due diligence and tax due diligence perspective. But a company sale, an ESOP, and a sale to an investment or a strategic buyer, the amount of time that the seller will spend getting together documents, doing the due diligence process is extremely intrusive, takes a lot of time, and sometimes very frustrating. So you have to have your mindset in a way that you understand that people are going to be questioning everything you do, and you have to support it, and you have to provide the information. Therefore, if you're thinking of a transition, like Kevin said, you got to think about it ahead of time. How do I get my financial and my tax house in order to make sure that that due diligence process is as efficient as possible? And Kevin, to your point, the ugly, the worst. I was a client as I came on the firm that was transitioning to me. Uh, the owner was extremely successful in his business, but called the audit partner, myself, one day and say, "Hey, I just sold 80% of my business." And we said, "Well, I wish you would have called us first." uh, uh, the strategic owner basically uh, strapped the company with a bunch of debt in order to effectuate the payout. It was a construction company, and if you're familiar with the construction industry, you got to keep a certain amount of equity, and you really can't. It's very delicate from a financial perspective. You have to run it really really well. It ended up that the company was not successful because the 80% owner thought he could fund everything through debt. He was a banker, didn't quite work for the construction industry. Uh, Everybody split up and they ended up suing each other, right? That's the ugly part. So again, I think in all these situations, you've got to think of the exit strategy, plan it accordingly, think of the tax, and then talk to someone like Monica, which will help you then determine once you get that nest egg out, uh, you cash out your investment. How are you going to live off of that? How are you going to leave for there's something for your family, and how it can be successful after the exit. So those are my examples. Like I said, I had 10 or 11. I can give you all details. I had several ESOPs, and other transactions, but those are the ones that stand out just because of one, very good planning, two, good planning but should have been thought about a little bit better, and the last one, don't tell anyone, don't vet it with anyone, and then it becomes a disaster.
Thank you, Peter. And I would just close it out by saying, planning, if even if you're not right at that point of the sale, it's still time. It's time to think about what you're doing now and what is that strategy. And we will work with Peter, with Kevin, with their teams together to add a lot of value to what you are evaluating and what your plans are. But thank you all for your time.